Welcome to this new webinar. Exactly, that's gonna be the second last webinar of our series. We have been going on for 3 months, and in fact, today and next week we will be covering the most advanced topics in terms of order flow analysis. Already the last two webinars we have introduced the liquidity as a principle, as an order flow element. And today as well, we are gonna move a little bit on that topic. We are gonna go deeper into the way sometimes aggressive orders would interact with liquidity so that we can spot easily absorption and exhaustion, looking at a heat map. And more specifically today, we are gonna go also deeper into two specific indicators, which the VolBook heat map as a software would provide to help us deciphering these absorption and excess as well. Those are two really interesting indicators because apart from the personal and discretionary assessment we can do to aggressive orders when they hit liquidity, we also have an algorithmic indication of when price is absorbed and when aggressive orders are actually making the so-called stop runs. So when an excess takes place in the market made by aggressive orders, which in some cases would correspond to stop losses getting hunted. So really interesting topic. We are gonna start straight away. Let me just get the software. Here it is. Okay, cool. So, just to make a quick recap of what we said last time, liquidity, let's make a quick analysis of what is gonna go on today in terms of liquidity. What is liquidity telling us? Basically, we have that's still S&P 500. We have price going away from all of this liquidity, being at the bottom, being below price, which of course give us a very nice confirmation of what actual price action is in terms of liquidity acting as a rejector for price. And by this situation, we can tell that price is likely to slowly get to trade these liquidity pools being located above. Okay, of course, this is not an analysis in terms of final assessment to decide to take a trade, but this is something just in terms of liquidity. Liquidity is telling us that there is more weight above the current price than below. That means that price might be easily attracted by this liquidity, which is to the upside. So if we would decide to short right here, it wouldn't be the best decision, considering that before eventually price would maybe reject levels right up here, would have to take and trade this liquidity first. But exactly, what do we need to see in order to assess a good rejection on a liquidity once this liquidity gets traded. We have to focus on the main order flow events, exactly as we were telling in previous webinars about absorption, exhaustion, to be seen in the footprint or in the cumulative delta as well. We can think the very same way here, but of course the informations provided by this kind of chart are slightly different, so we have to look at different situations. Let's make an example of absorption, for example. When do we have an absorption? Let's go back to check if we have a proper example. This is back in the morning. That's my time, 11, 10, 12 o'clock, and so on. That's a very nice example of absorption. Why? Because we have price shopping around here. We have this block of, that's not so neat, but we have a recognizable block of liquidity below price. Already the shape of this liquidity, because it involves many levels, it is not neat on a specific level or in a specific area, suggests us that that's a liquidity which is more likely to act as a rejection for price. So that's the first information. Then what do we see here? Price trades this area, and liquidity right below price is thickening. Okay, we can see that colors would become darker, more intense, and suddenly, what's the next clue? This big red bubble right here. This bubble would represent a nice amount of aggressive trades to the downside, so aggressive selling, apparently trying to hit this liquidity and to eventually break through. Okay, but apparently they don't make it, because price bounces immediately back up. They make a new attempt right here, and you can see that in this new attempt they make attacking this liquidity, there are no sellers at all, or at least there are way less aggressive sellers in the very same area compared to the ones there used to be at the previous attempt. And that refers to an area where we had liquidity right below. That's exactly what happens when we have an absorption. We have absorption where we have a strong amount of aggressive sellers trying to hit a level providing liquidity. Of course, the stronger liquidity is, the better absorption we can have in that area. But then they just fail. They just fail. They just ran out of weapons. And at that stage, it's where buyers, so aggressive traders in the other way, are taking control, are initiating in the other direction, to the opposite direction compared to the aggressive sellers, in this case, trying to hit that liquidity and break it. We can have lots of examples of this dynamic. Same thing here, this time on the opposite way. Here at the top, we have this nice block of liquidity. As we reach and approach this liquidity, you can see that buyers are getting always more aggressive. Okay, you can see that bubbles are getting bigger. They hit the liquidity here, they would hit liquidity here, but if you compare the result to the effort they have put on this area, we can definitely say that all of these traders, okay, actually they are pushing hard to the upside, but apparently they're not making this great job, as price can't actually follow their actions. They are buying, buying, and buying lots of quantities, but apparently price struggles to go up. The main clue is that in order to start determining that we are in an absorption area, is looking at this bubble. This example is 100% perfect here, because we can see that the aggression of buyers comes exactly within the area providing liquidity. And immediately straight after, we have no follow through of this buyer keeping on pushing in their direction, the original direction. On the opposite side, we have this nice little swing made only by aggressive sellers, majority of aggressive sellers. So from here on, we can already say, okay, for sure, buyers are struggling to break through that liquidity. And that could be already a nice, interesting situation. It depends how aggressive you want to be in your trade. Because if you are aggressive enough, from this situation on, you could already say, okay, that's going to be an aggressive trade, but if I enter the trade without waiting for further confirmations, I can benefit from having a very tight and close stop loss to my entry point, but basing my entry on an order flow dynamic which already makes sense. Of course, I can't really say that's absorption until we are still here. We need at least to see that at least we have price going in the other way below the previous absorption area, looking at there is no follow through in pushing to the upside anymore. Okay, but let's assume that we want to be even more aggressive, even a little bit more conservative on that, and we're just going to wait for further confirmations. What happens next? We have another pullback right here on the very same area where previously the absorption took place. And the question is obvious. Do we still have the same effort on pushing to the upside? Well, not at all, judging by the size of the green bubbles trying to push through once again. In this case, we have green big bubbles. Here we have a second attempt made by really tiny bubbles, green tiny bubbles, which would express what? Exhaustion. You remember when we were talking about order flow events, a reference to footprint chart and cumulative delta as well. We said that most of the times absorptions are very good evidences by themselves, but sometimes they just need to be confirmed by an exhaustion. And ideally, the couple absorption first with an exhausted pullback, that's definitely the best combination. Why? Because an absorption would tell me that despite their effort, they can't go through. They're struggling. The exhausted pullback is telling me that this time they are not even trying to break through. So if in the prior attempt we had at least a try to break the level, but even if they have traded so many volume, they didn't make it anyway, the dynamic is going to be even weaker if that's confirmed by an exhausted pullback, telling me that this time they are way weaker than they were. So after an exhausted pullback, I have the perfect confirmation that I ideally can have on such situation. And then in this specific situation, everything was wonderfully confirmed even further by what? Liquidity provision. Why? What happened here? Even if I need to zoom out a little bit. Well, during the first attempt, liquidity has blocked aggressive sellers since price then went down. But anyway, if you look at the band showing liquidity, we can tell that here in between, those aggressive sellers were able anyway to consume some of it anyway. Even if it didn't go through, they were able anyway to take out some of this liquidity, which used to be right here. In fact, if we use this tool, located here at the bottom of the screen, this right here, it allows us to, by just putting the cursor where I want to see how much liquidity, how many contracts I had at that specific time. Here we had roughly in the most populated level 450 lots sitting in the order book. After those aggressive buyers, hit the level, we had 158 left. Okay, so they weren't able to break the door. They were just able to crack it. Let's put it this way. They have made some effort with a partial result. Well, still an absorption. It doesn't matter. We can still consider that as an absorption. But then after, what happened a few seconds after? The liquidity grows again. Here it comes back to 320, 242. Then, of course, it changes a little bit second by second, but roughly around 320. That means what? That passive sellers providing liquidity are reloading the ask. So apparently they are absorbing aggressive traders even more aggressively than an ordinary absorption as it would be in this case. Some of the contracts were taken out, they are adding more. So basically, aggressive buyers have cracked the door, but passive sellers have fixed that crack immediately. We can put it this way. So compared to what's happening in terms of order flow events, so absorption here and exhaustion here, this is an amazing confirmation provided also by liquidity evolution, the way liquidity changes over time and over event. That confirms that this level was great to look for a bounce in price. We had this interaction of price hitting the liquidity, and apparently who has won this battle? Apparently sellers. Passive sellers at first, and then aggressive after. They started being passive, and then they became even more aggressive. But in overall, sellers have won that fight. That represents very well what we should be waiting for when we have massive liquidity levels like this one. As price rises here, it could have been dangerous to short, because we could tell that price could easily try to reach here, especially consider that as price rises, as we can see, we also always have liquidity stepping behind price, trying to sustain it. But after liquidity, once liquidity is hit and traded, we have an interaction. If we assess that interaction looking at order flow events like absorption and exhaustion specifically, those are the two most common order flow events, we can determine what happens when price arrives on liquidity level, on a specific liquidity level. So as a rule of thumb, we have an absorption when we have big bubbles, big sized bubbles hitting a liquidity pool. So we need to see the bubbles being within the area, or at least just touching it. And normally that corresponds to a peak either in volume, if you are using a volume indicator like this one I have, or if you prefer, we can also use a cumulative volume delta, daily one, a CVD, a plain CVD. which would show which would show us a peak anyway. Personally, I prefer using this indicator, the volume indicator. That's a plain volume indicator just made by volume histograms. Each histogram is the summary of the last 3 bubbles. Okay, so it's very fast in terms of settings. And the inside color would show delta, still cumulative delta for the last 3 bubbles. So in this case, when we have absorption, we tend to have a peak in volume histogram corresponding to the area where the absorption takes place, with a dark delta, a strong delta, representing the effort made, the effort in terms of energy eating the liquidity. As opposed to that, exhaustion comes with low volume. We have small bubbles, especially we need to check to have small sized bubbles in the side we are trying to assess the exhaustion. So if we are looking at here to see if buyers are really exhausted, we need to pay more attention to green bubbles. We need to check if green bubbles are really tiny compared to the red ones. Well, in this case, we have both green bubbles and red bubbles being tiny. So that's good as anyway as an exhaustion, because what we really care about is that green bubbles are tiny. But if we also have an asymmetry between small green bubbles and big red bubbles going away, it's even better, of course. But normally exhaustion comes with low volume and low delta as well. In the area, you would see that delta histograms are lights. We have green light, green red. We don't have relevant effort, neither to the upside nor to the downside. Same thing on the cumulative delta. As opposed as to this peak here, we have a flat zone here. Same thing, but still, personally, I prefer using this one because it gives you a much clearer view of what's happening in terms of bubbles. So ideally, exhaustion, small bubbles, absorption, big bubbles, big volume and big delta, as opposed to exhaustion, small volume and small delta. Now, sometimes happens that, of course, liquidity pools also get broken through. Otherwise, if on every liquidity pool we had an absorption or an exhaustion, we would have markets always being sideways. It would be too easy, right? Sometimes liquidity pools gets broken through. And this is what has happened here. Well, this liquidity wasn't that strong, and we can see that as price was approaching it, it was slowly thinning by itself without any aggressive traders hitting that. Price gets just through that. How can we determine when a break of a liquidity level is a genuine one? First of all, we need to see what happens as price goes below or above, goes beyond in overall the liquidity pool. In this case, we can see that price breakthrough. We have a nice initiative to the downside by sellers beyond the level. So we can tell that there is either participation beyond the liquidity level, and also acceptance of price. Price is not rejecting straight below. And this is the first clue which tells us, okay, these levels was broken. Ideally, when we have a break of a liquidity level, my suggestion will always be to wait for a pullback before making any decision. Because quite often we can have break becoming fake outs. Because if you think about that, we can also have, I'm gonna draw it for you so it can be easily understood. Let's assume I have a liquidity level here. No, that's not visible. Let's make it red. I have a liquidity here. Price attacks it. So we have huge red bubbles. Price goes slightly beyond, but then once it gets beyond, suddenly red bubbles become very, very tiny. Price starts to bounce and it comes back with green bubbles becoming always stronger. Can this situation be still considered as an absorption? Of course it can, because we always have to consider the areas of liquidity provision as areas, not as a straight line. If we just look very closely at bubbles and what has happened here compared to order flow events and what we have said about that, I have a price pushing hard to break this level. Okay, as it goes beyond, we have exhaustion. Small bubbles. With immediately after initiative to the opposite side. Back into the liquidity level. And above the area where we had big red bubbles, mm, suggesting that the level was getting absorbed there. So still an absorption, but that's a variation of the normal absorption we have talked about a few minutes ago. That's a combination between some absorption here, because big bubbles here show that price actually they are struggling a little bit to go down. They are encountering counter liquidity, which of course is there. We don't have to guess that, it's there, we can see it. But then weapons are out, so they get exhausted, and aggressive traders in the other side initiate the move back above the liquidity and back above the previous effort of sellers. Okay, so in order, this can be still considered as a reversal pattern, a valid reversal pattern when we reach a level of liquidity. But in terms of breakthrough a level of liquidity, in order to avoid this possible situation, and maybe to avoid selling here, we need to see that there is a proper acceptance pass beyond the liquidity, which in other cases we shouldn't have, like this one. So once we have that confirmed, the best thing we can ever do is waiting for a pullback on the level where previously the liquidity was broken to eventually assess a continuation trade, which in some cases, like this one, it is confirmed by what? A nice protection of liquidity coming from above, slowly being scaled to the downside. Here we had this top exhausted by buyers. Can you see small bubbles, small volume here, besides this peak here, but then volume was very low. And then sellers here take back control. And also we have this liquidity being added straight above the price, adding a further protection to the possible trade. This is what normally tends to happen when a liquidity level gets broken through. So ideally a situation where aggressive traders win over passive traders. Now, I know that I have a question that, sorry, just, is it possible to tell the difference between human and algo orders? Yes, yeah, definitely, definitely. Uh, that's the one way to actually detect algo orders being in play. It's one of the things I'm gonna be explaining in a little while. So yeah, definitely it is possible. And sometimes you can also predict when it's the best moment for algo to come into play. Let's go through this right away, talking about absorption and stop run indicator. We have talked about absorption so far, assessed through, let's say, well, another very nice absorption here. Big bubbles, peak in volume, peak in delta. And here, exhausted. That's an exhausted pullback right here. Flat CVD, flat volume indicator, and light colors and small bubbles. I'm just looking for an example where we had the absorption indicator. Yeah, here it is. Sorry guys, just hang on a few seconds. Okay, yeah, need a better example. Okay, here it is. So by just looking at big bubbles hitting a liquidity level, we can tell and determine where an absorption is taking place. But of course, this is a discretionary assessment we can do. This platform, VolBook, provides also an indicator detecting absorption. So it's like an absorption detector. I'm gonna show you the settings because, of course, how can it detect when aggressive orders gets absorbed? It needs a couple thresholds in numbers. Okay, so that's the indicator. Basically, it would detect an absorption when we have, according to my personal settings, when we have at least 400 volume being aggressive on a certain area. So 400 lots hitting the bid or the ask in the same area, executing in no more than 5 milliseconds between one and the next one, which altogether they can't make price move for more than 4 ticks. So that's definitely an algorithmic detection of what absorption is. Absorption is basically lots of volume not being able to move price. So according to my setting, I can decide to make it a little bit conservative and then decide that 400 volume is good, 5 milliseconds is good, but I want it to be more conservative and consider all of those situations not being able to move price for more than 2 ticks. And in this case, in fact, as you can see, many of the instances have disappeared. The outcome of this indicator will be those labels with a number inside. More specifically, The blue color would mark an absorption of buyers. A pink color would represent an absorption of sellers. And the number within this square tells me the number of contracts which have created that dynamic. And in fact, as you can see, they are all more than 400, which is the threshold I've decided to set. Using this kind of indicator, of course, we don't have to worry about being right or being wrong on picking up an absorption and trade it, because that's algorithmic. Whatever represent that dynamic with those numbers, it's good. It's give us an outcome. Here it is. But on the other side, what happens if I have an absorption which can still be considered as an absorption, but it doesn't meet those criteria? Of course, that won't be shown as an absorption by the indicator. We have to assess it by ourselves. So my suggestion is, let's keep this indicator, because sometimes it can help, can be really helpful to highlight all of those situations where, for example, a normal absorption can be that obvious, but it matches certain criteria. So once I have these, how can I trade it? I have absorption here of buyers, but then price continued to go up. Exactly, as well as we were talking about normal absorption, we always need to see that sellers, so the opposite aggressors, are initiating below on the opposite side of that absorption. Like here. Here, it could have been a nice short trade according to this indicator, because after this indicator is made, has created this rectangle, we can't preempt that from here on is gonna go down. Sometimes we will be right if we preempt that, but it can be extremely dangerous sometimes. We always need to see that actually sellers are really initiating past that absorption. Absorption still tells, even if they are struggling, absorption still tells me that I have participation of buyers. They are struggling, but they are still participating. In fact, this is what happens here. They are still trying to push to the upside, but from here on, they've started to struggle apparently. And from here on, they gave up. Same thing here. Another absorption of buyers, 529. No follow through at all, but then it starts to get really interesting when we have initiative by sellers taking place, confirming that your buyers were not always struggling, but they eventually gave up. So this is a very nice way we can use this absorption indicator. Something similar, but working with a different perspective, is the stop run indicator, which is the indicator providing this First of all, what is a stop run? Ideally, a stop run is uh, an irrelevant number of small aggressive orders hitting the bid or the offer all together with small sizes but within a few milliseconds of distance from one to each other. So it's like we have a stop run. We can have a stop run if at a certain level we have 500 contracts buying aggressively, but they're not buying all together. They're buying 1, 5, 10, 15, 8, all of these orders within a few milliseconds. And this is exactly what sometimes algos will do. Sometimes algos would do that. Some other times, stop runs are caused by what? Stop losses getting hit. Because if you think about that, let's assume there are a few traders being short right here. Okay, they've entered short on this down move. They are short. Their exit, their stop loss order, it will be, of course, to close a selling position you need to buy. You will have a buy order here, but that would be, since that's an order, a buying order placed above the current price, it will be a buy stop order, which, as we said when talking about the market microstructure, they're gonna be converted to market orders by the exchange when the trigger level gets hit. So imagine, so they will become bubbles, okay, aggressive orders. So imagine if market comes back here and there are hundreds of buy stop orders, but made of different traders, because many people have entered short here, and there will be one buy stop here, another buy stop here, 10 buy stops here, and so on. When market hits this level again, all of these aggressive order will enter the market and, according to this example, hitting the ask all together. But they are taken, if we take them singularly, they are small orders. They are 1, 15, 5, 3, 10, and so on. But all together, it will result in 500 contracts hitting all together the ask, producing a stop run, exactly what the stop run is. So the indicator for stop run thinks exactly the very same way as the absorption indicator, but on another perspective, because in this case, I still want to have shown stop runs made by at least 400 lots with a distance of 5 milliseconds of execution from one to the next one. which is able, the stop run is able to slip the market, let the market slip at least 5 ticks. In the absorption, I need market not to move more than a number of ticks. In the stop run, I need the market to move for more than at least an amount of ticks. In this case, for the S&P 500, those are my settings. Because normally, even if we have stop runs, that's not a volatile market. It's unlikely, even during stop run, it is unlikely that stop runs let it move more than 5, 7 ticks. That's really, really unlikely. So 5 ticks is a good balance between an aggressive setting and a conservative setting for the stop run indicator. So when can we consider that as stop loss getting hit or algo activities? Well, quite easy to tell. Because normally, let's see if we have some example somewhere here. If I remember right, we had one a little while ago. Yeah, here it is. Oh, shit. Sorry. Look at that. 817 lots hitting the bid, the bid all together, producing this quick move to the downside. The pink diamond shows us that that's a stop run to the downside. So that's a bearish stop run. That means that the aggressive orders were selling orders. And apparently those selling orders appeared exactly where a previous low was broken. That shows clearly that there were a few stop losses being placed here, and unfortunately for them, they were hit and filled. This has caused the stop run. So in this case, that gives us a nice idea of trading this dynamic as a reversal. Because that means what? That the strength being spent in breaking this low wasn't a genuine intention of sellers selling and breaking that low. It was just lots of energy made by those stop losses getting hit, and at the moment providing aggressive trades to the bid. So it's like we can see this push to the downside as accidental, not intentional. So if after that we can see the counter force slowly picking up, that's a good situation where we can trade a reverse. Of course, according to the other plans that you have. Maybe there was already a reference level because there was a market value area, because there was naked POC of a volume profile. Of course, if there are confluences, it's always better. But by itself, at least, that means one thing. Don't short here. Don't short here after such a situation. Unless you can see after the stop run, then market comes beyond the level where so much force was provided and they still continue to sell. This time initiating without a stop run. In this case, yeah, it can consider as a genuine initiating to the downside. Rather than this, when we have instead stop runs occurring at the not on a specific level as it happened here, it is more likely to be algos activity. Those diamonds are blue, so they would show stop runs in the ask, hitting the ask. Well, according to the chart, there doesn't really tell me here. Some traders are being stopped out as a discretionary hypothesis. But normally, when they are so close each other, that would represent algo activity, which normally, why do they push with such a force in one way? Well, 90% of times because they're trying to reach a previous level of liquidity being in that direction. So that's a stop run to the upside. They are trying to reach a previous level of liquidity being in that side of the book. Those are way more difficult to be traded because in situations like this, personally, I wouldn't have been able to decipher that at the moment. I have to be honest. But first thing that I can say, here in this situation, there are algos trading. I have to be freaking careful then. First of all. Then, what happens after those stop runs are launched to the market? How does the market react to them? Well, the stop run is to the upside, okay? So, as a rule of thumb, it should go up. The next move should be up. Okay, cool. But in order to try go in that direction, I need at least to see a confirmation of initiation above, at least. Which in this case, it makes sense, because if price, I can see that they are initiating above previous bullish stop runs, that means that they're likely to want to execute themselves on this liquidity, which is a few ticks away. Well, it wouldn't have been that much of a trade, but ideally it makes sense. Personally, I prefer using the stop run as detection of false breakouts. So when they give us the idea of stop losses getting triggered. In terms of algos trading, it varies so much by the situation. But as a rule of thumb, they will always try to launch these stop runs to bring price, to drive price to a liquidity being provided in that direction. So ideally this one. Okay, that's it for tonight. Please, if you have some questions, uh, you can write them down in the chat. Lots of things tonight. I hope everything was clear. Next time, yeah, sorry.
Edoardo, looks like there is not another question. Yeah, is the one that you already answered. Yeah, next time.
Yes, next time that's gonna be the the top of the advanced order flow analysis. We are gonna talk about iceberg orders. So definitely something really interesting which relates a, a, a lot with what we have talked about tonight, especially absorption. So I hope you will attend. So far, I thank you everybody for your participation as usual. And so wish you a good evening to everybody and see you next week.